this is a good little topic here. How to stay bullish with less risk. I mean, that's kind of the theme for at least what I was saying for today. Let's take a look at it.
Mm-hmm.
First slide, please. Thank you. When traders are bullish, the first instinct is to often sell a naked put, a simple, high probability, and direct exposure to the upside. I mean, I think when people first start trading, if they're following along or with somebody else that they're mentoring or monitoring, they always say, naked put's the easiest thing, high probability of success. Use a little bit more buying power, but that's the place to go. It's easy for people. It's almost like a covered call. It's easy for people to understand what a covered call is. It's easy to understand what a naked put is. But for smaller accounts, that trade can tie up a lot of buying power. That's what I was just saying a moment ago. It can carry large downside risk, right? I mean, I guess the large downside risk could go to zero if that's such a thing in the time frame of your trade there, being around 45 days when we would do it. In this market measure, we'll show how you can keep nearly the same bullish exposure while cutting max loss and buying power. What do you think they're going to do here, Jamal, to do that?
Do I think they're going to do? I think something maybe that I do every now and again. I was thinking a calendar call or something like that.
Sure, or define the risk, maybe buy a wing kind of thing.
Yeah, exactly. Keep and define risk.
I think that'll be the simplest thing to do. Let's go to the next slide, please. The study, 5 years of data in an ETF like SPY, which is a large price product now, $680 some odd, right? I mean, it's no longer the $100 or $200 product it once was, so it used a lot of buying power. And individual stocks like Apple, which is near all-time highs in Apple, so obviously going to use a lot of buying power. So 30 delta short naked put and a 30 delta and a 30 delta, 10% out of the money short put spread. So they're going to sell the 30 delta naked or sell the 30 delta naked and buy a 10 delta short put to define the risk, which I was alluding to. 45-day strangles and manage at 21 days. Computed with a win rate, average P&L, average buying power, max loss. We did the analysis by comparing the results. So let's go to the next slide, please. A common strategy by new traders is to buy or sell the outright. For example, selling a put in SPY or in Tesla. Great strategy, but requires a significant buying power. I don't know about great strategy. It's great strategy if the stock goes higher, right?
Right. Everything's relative.
Everything has to be validated by getting the directional move correct. It's S&P 45 days at 21 days closed. They're looking at the 30 delta put in a bullish scenario here because that's what we have here. The average P&L is $127, but look at the buying power, $8,600, and in Apple, great average P&L, $229, but you're using a lot of buying power, almost $12,500 in there. So you're using a lot of buying power out of the reach for a small sized account here, right? Any account under $25,000, this is going to be way too much money. Let's go to the
not very efficient use of capital.
Not very efficient use of capital. Let's go to the next one. Great strategy, not very efficient use of capital. So simple way to reduce this risk while maintaining the short put exposure or the long delta. That's what short put would be, long delta, is to buy a further out of the money put option. The lower your average P&L, it will lower your average P&L, but uses less buying power and reduces your max loss position. Obviously, if you have a defined risk trade, you're going to use a lot less buying power. Let's take a look at that. The SPY 45-day 30 delta put, and then underneath that, you got the 30 delta put plus the $10 out of the money spread. That's what they're changing here from the last slide to this slide. You'll see the buying power goes down to just around 3,000 if we're all friends here, just from $8,600. So a significant reduction in buying power, over 50% reduction in buying power. But look at your P&L. Your P&L goes down by over 50%, $42 versus that $127. Obviously, your max loss is going to go down too. But your win rate hangs in there, 78% to 74%. Let's look at the Apple. Same thing here. You're using buying power of 12,000. Now you're only using buying power of 3,700. But again, your average P&L is going to go down and go down significantly. I mean, there's no way to to sugarcoat this. You make less money because you have less opportunity, but you're using less buying power on the overall trade. Your win rate goes to 70% from 75. So there is definitely a gimme for a gotcha for everything that Dr. Jim would say just a moment ago. Next slide, please. All right, so even though buying the further out of the money put defines your risk and reduces your average P&L, you maintain very similar directional exposure to the naked put. Would you have any argument with that statement, Jamal?
Well, it's true. It's correct. So the directional exposure is the same. It's just obviously risk is different.
And the naked put might be out of your your buying power range, right? So then you can't play the game.
Yeah.
The average correlation in P&L for naked put with 10% out of the money put spread is about 90%. So you're getting about a 90% correlation. Yeah, remember, correlation only measures the directional similarities and not the magnitude. That's the P&L difference, because the P&L difference, is significant. I mean, when you're buying, wings, or especially in something like SPY, which we used here, and Apple not so much, because Apple usually has some call side skew or maybe a little bit of equal skew on each side. SPY definitely has put skew.
Yeah.
The out of the money puts are going to have a lot more premium relative to their price because of that tail risk of going down to the downside. That's how people protect their positions, by that tail risk. So you're paying a lot for that 10 delta put relative to the put that you're selling at 30 deltas, even though the 30 delta put is obviously going to trade at a higher price. It's interesting here. I have some short premium in SPY, and even the S&Ps are down 3, really haven't moved anywhere. SPY is completely unchanged, and my position's down small from over the weekend. And that's all because volatility is up 1.5%, that 30 cents, on top of the move in volatility that we did not get over the weekend. So there is a lot of premium opportunity to sell in SPY, and making it even more advantageous for you to roll down to reduce your delta in one direction or the other if you're having some inklings on what the market is doing right now. Let's go to the next slide, please. Additionally, max losses are smaller for put spreads, especially during some sell-offs, which is an important consideration for tasty bite accounts. I mean, yeah, listen, it's going to move a lot slower because you have the opportunity to make less, but that's what you want in a smaller tasty bites type account, right? The magnitude of the move and the swings here, $100 in a tasty bites account is completely different than $100 in a $100,000 margin account.
For sure.
You might not even be looking at the position in a margin account because you're used to those types of swings, not because you can afford to lose the $100. That's not the point here. Those swings are going to be a lot bigger because you're taking on more risk. In a tasty bites account, you don't like to see those triple-digit moves in any one direction, even to the upside, believe it or not, because it means you're trading too big.
Yeah, you see a lot more volatility in a portfolio, in a tasty bite portfolio, versus a bigger account, right?
Yep.
You can just manage it. You can actually work through some of these big drawdowns here that you see in some of these.
And look at this, the $6,000, even the $4,000, and a lot of $2,000 moves in those monthly, remember, this is not yearly, this is monthly maximum losses over time. And then Apple, you consistently in that $4,000 range. They're way too big, and then $14,000 in 2025 there. So way too big for most accounts. So I think for most people here, especially the newer trader, absolutely the tasty bites account, you have to define the risk. That's really what it comes down to here. I think this is all pointing to you have to define the risk. Next slide, please. Additionally, buying powers are smaller for the put spread, also an important consideration for Tasty Bites account. Here's your buying power over time, how much you're using. I think it's pretty self-explanatory here too, between SPY and Apple, the green versus the blue on there. The green being the blue being the put. You're using a lot more buying power. Right. And as Apple price grows and as SPY price grows, the same probability of success trade is going to use a lot more buying power than you had previously used because the stock price has gone higher, and that's how the margin or buying power is disseminated by the price. Next question. Next slide, please.
If only all charts look like that.
What's that?
Only all P&L charts look
Yeah. If they all went in the same direction like that, it would be good. Agreed. You can apply these downsizing mechanics to other naked strategies to reduce the buying power. Every trade that we put on here that has undefined risk and uses too much buying power for your account, there is always a workaround where you can use less buying power by defining the risk or doing something, even calendarized, doing something to use significantly less buying power. There's no stock that's out of reach. Even, the $1,000 stocks, the $2,000 stocks, if the markets are good enough for you, there's always something you can do that even a small account can participate in those stocks. That's what makes option trading so valuable to everyone, because you can have the whole world, futures, options, commodity options, all allow you to trade products that you otherwise would not be able to trade if you just had to trade the underlying or just the future itself. It might be too big for you. The strategy to reduce the buying power here, naked put by, making a put spread. Same thing with a call spread, strangles, buy further out of the money options. I mean, it's called an iron condor because it's 4 legs, but you're buying those wings just to reduce your buying power. Iron fly, butterfly, no matter what you do, you can always simulate on a risk graph the same type of positions. Next question. Next slide for the takeaways, please. As even the S&Ps have made their highs this morning before the show is over, and now making their lows at 86.66, down around 7. NASDAQ still green, up 88, and volatility up 31 cents. Takeaways, naked options are our go-to choice because of their ease in management. That's another thing we didn't really bang in there that they're mentioned here. One option is a lot easier to trade than 2 or 4 options, even if there's less delta risk in the 2 and 4 options. Large credits and high win rates, that's what everybody likes to see here. And smaller accounts can replicate the performance of naked options by adding long wings to define the risk. Absolutely. The long option can be chosen based on a fixed strike, like they did here, 30 deltas, kind of our sweet spot, somewhere between the 30 and 15 delta, a percentage out of the money, a target delta, or even a specific dollar width. Nothing wrong with saying, especially in a Tasty Bites account, because that's what we're talking about here, that for my risk tolerance and for my size portfolio, $5 wide is all that I'm going. So then what you would do is, you wanted more or less risk, you would move your whole spread down or your whole spread up, right? Keeping it $5 wide. Yep. Not looking to increase the number of contracts. Would you agree?
Yeah, for sure. I mean, I think it really rings home for, there's some people who probably queue up that short put and see the amount you can collect and even see the size. And I think for some people, they're like, well, this is probably pretty big, but I'm going to put it on anyway. And then it becomes such a big position that it takes over their whole mindset, their portfolio. Being able to spread off your risk, I think, always helps. Options give you options.